Okay, great. Welcome to another edition of Real Estate Investor Talk. And sitting next to me is Bill Rawson. Bill is the chairman of Rawson Properties. Bill, first of all, thank you very much for your time.
Pleasure.
Bill, first of all, we had this fantastic interview about yourself. You're a doyen in the industry, in the property industry. Give us a little bit of background about yourself, where it started, and then later on we can talk about sort of the market and some advice for investors. But give us a little bit of a background of where it started in the industry. I mean, you are a doyen. Tell us about it.
It started small many years ago in 1972. I entered the property market in 1971, and I learned the methodology of investing by the principle of gearing. And I was one of the first folk to catch on to that. In other words, using other people's money, or alternatively the bank's money and not yours, and trying to achieve and getting a higher return than you are paying on the interest for that money.
Where did you pick up all these tips? I mean, is it something that you just sort of developed over time? Did you read books? Did you get different sources?
Yes,
No,
two sugar, one sugar.
Okay.
It was being trained as an accountant. I did the figures.
Okay.
And I tried to figure out ways as well of how I could increase my wealth. And in reading books on many other wealthy people, how they had accumulated their wealth, and the majority of people had accumulated wealth through the principle of passive income.
Mm-hmm.
And basically that means what you buy today will appreciate by inflation, etc., shortage over the years going forward.
Right.
And so if you bought something today at 100,000 Rand, in 5 years' time at a 15% return, it should be 200,000 Rand, and so on. So I figured that this principle continues. It certainly tracks a 10 and a 20-year period. You will have odd hiccups in the short term, but it's a very worthwhile principle. So if you can get a 15% return and you can borrow money at 10%, then you are up at 5%, assuming you have no income stream from that property during the period.
Mm-hmm.
If you have an income stream of say 10% or 8%, you're up a further 8 or 10%. So you combine the passive income and the active income together, you should be achieving 20 to 25% or even more greater returns depending on the type of investment you've made. Mm-hmm. And the ability for you to sell or realize that profit or exit that investment opportunity. So it's actually quite a simple principle, which a lot of people would rather spend, say, 100,000 Rand buying a new motor car,
mm-hmm.
which when you take it off the showroom floor, it loses 30%.
Mm-hmm.
Crazily enough, the banks would actually prefer to finance that motor car and lose 30% of the asset value,
mm-hmm.
but charge you a greater interest rate on that, on a totally unsecure investment. So it's never made sense to me how the banks look at these things other than in the short term and trying to bank pieces of paper which says I owe you 100,000 Rand. Where property really is the background of the industry. But the banks can also screw up the property market, as they have done recently by offloading all the properties in totally totally irresponsible way, putting them up for auction.
Mm-hmm.
And I say this because the only people who go to auctions are people with cash in their pocket, because you can't go there and bid saying, hey, this is subject to a mortgage bond.
Mm-hmm.
So the banks devalue their whole asset base in this recent economic turmoil by almost 50%. Crazy.
Just okay. So Bill, just getting back to your whole principle investing, you obviously implemented a lot of this yourself. I mean, you used it, you learned the sort of the methodologies, and you applied it.
Yeah.
And it obviously worked for you. So
apply to that still, even in property. You can apply the same principle to property investment and property development.
Right.
If you understand the principles of property development as well.
Okay.
So you can take short-term cash, or you can put your cash in and you can borrow. And often people do, they borrow what is called mezzanine finance to kickstart the development at a higher interest rate. But you have to be careful. You have to do your numbers correctly, and you can't afford to make any mistakes. And to believe me, there are many who make mistakes, and we have certainly made mistakes, and this is where we've learned from them. Mm-hmm. But we check, and we double check, and we triple check. And even unfortunately, I have to say the professional teams also make mistakes that you employ. So you have to check their work and get their work checked by somebody else. So always a lot of checking. Okay. But ultimately, there's or having been in the industry for so long, there is what I call a gut feel.
Mm-hmm.
And if the gut feel is there, and then that's good.
Okay, so let's get a little bit get back to what you were saying earlier on about the markets and the banks putting everything out for auction and that kind of stuff. So what do you think? I mean, what should be happening in your opinion? We are in an international economic crisis. Some people say yes, no. I mean, some say it's deeper than it really is in the US and also in the Eurozone. And obviously there's a little bit of panic, there's a bit of fear out there. So what would your advice to be for somebody? I know that there's obviously bargains out there and all that kind of stuff. So what would your advice be to first of all, the home buyer, and I think secondly, the investor, the more sort of investor who's trying to build a portfolio property? What should be happening, and how should the banks be behaving in your opinion, just in relation to putting the stock on the market and letting prices sell for rock bottom?
I think from the investor point of view, if you can deal with that aspect first of all, there are many casual investors who do not study the market, and I'm a great believer in studying and becoming an expert in what you want to do. And so when I invest, I know that area, I study the area, I read up about it, I go to the show houses, I talk to the agents, because even talking to the agents, you have one agent has an opinion which is completely different to another agent who has an opinion. The same as differing opinion to the one you've spoken to earlier on. But these are all sources of information which are freely available to investors, which they don't use. Then of course you'll read the papers and you'll read the net today. And then I'll go and study what has been sold in the market and look at the past year. Look at a 6-month trend and look at a 12-month trend. I don't really look at it longer than 12 months because the market does change, unless it's into a micro market, which you're not looking for much activity in a 12-month period. Then you'll look at 24 and 36 months period. So if I have to say that one of the biggest problems or one of the weaknesses in many folks' investment strategy in the residential property market is they are casual investors. They don't look at study the market. And basically, they also don't have the time. But I would suggest that even whilst I'm being critical of that, it's probably far safer investment than the share market. Mm-hmm. The share market, you also have to study and watch and see. Very seldom do people actually analyze who's the management of that company on the share market. What are their products? What is their vision going forward? They don't go into the detail of that either. Mm-hmm. So many people just want to give you their money or invest their money and hope that you're going to make money for them. And I think that's the wrong perception or the wrong attitude to have. You've got to look after your money, you've got to care for your money that you've been given or that you've made. And so then the next principle is to try and get a good banker that'll fund you. Now, in the old days, and I go back, say, 10 years ago plus, bankers and their clients had what we call relationships. And the banker would meet you and chat to you and understand you, and from that they pick up a feeling about you, whether you're honest or you have integrity, etc. Those values, unfortunately, have gone right out the door. You now are assessed by a computer in terms of numbers, which is very difficult to trade under those conditions. So try and find a banker who still will have that personal touch. And what they do, they call it private banking these days. So if you can find a private banker working for a bank that has got a vision and an appetite for supporting investors in the property market, then go along with that bank. Don't be loyal to any bank. Shop around on an annual basis and find the best banker for you that suits you and works with you. So for certain things, I have various bankers that I work with, and others I work with other banks. And each one has a speciality, and often they also are a wealth of knowledge. Recently I was looking to buy some property, and I got my banker to check the property out and even the owner out before buying, and they came back with a word of caution, which I appreciated. Please check his figures. In the past he hasn't been totally honest with us in giving us his figures, etc. And I appreciated that. Obviously I've got to make the decision myself, and I'll be accountable for the decision that I make myself. So with the banks and the mortgage market or the property market in general, I think the banks are tidying up their books from their losses from 2007, 2008, and they're going to have to start lending. They have to lend to make money. So whilst they've been very cautious in lending to people in terms of the National Credit Act, as we still haven't had any outrageous court cases. I mean, what I'm saying here is outrageous in terms of the consumer, right, where the Act actually allows the consumer to sue the bank for non-repayment of the capital, alternatively non-repayment of interest, if they can prove that the interest was unaffordable by the consumer, and if they can assume that the non-repayment of the capital if the bank was totally irresponsible. So once we have those court cases, I think that, and they haven't come up yet, I can well understand it, because the consumer's a small man, and the bank's got huge deep pockets to fund any court case. But there will come a time when this will happen, and then I think the banks might ease up on their lending once they've been tested, all these principles of the National Credit Act have been tested. And we'll get back into a reasonable format of lending again, but I don't expect anything that we have had in the 2000s to come back to the market. That was totally irresponsible as far as I'm concerned, and created a boom which was not sustainable.
Okay, so that's more or less the investor. Let's talk a little bit about the home buyer, because I mean the one are related to each other, same principles, that kind of stuff in terms of lending and all that. It's slightly different, but I think that for a lot of home buyers now, they can get good value.
Investors can get very good value, and home buyers can get good value. And I think just yesterday I had a home seller, in fact, phoned me for advice. He asked me for advice a year ago on selling of his property, and I gave him a ballpark figure that I felt that the property should sell for. And he phoned me yesterday saying, well, it's a year ago since we last spoke, and I've now got this cash offer on my table, which is 30% less than the peak you said it could go for. However, it was more in the ballpark of the lower end of that you said it might go for. What should I do? Do you see the market rising? And my answer to him was, sell it if you feel that you can do buy into this present market exactly the same money at the same sort of discount. So I think that's a very important principle. When selling, sell if you can sell at a low price, providing you're buying back in the market. Buying into the market right now, there are properties that are highly priced, and there are properties that are fairly priced, as there always is. And you must remember that each seller has their reason for selling, which might be economics, it might not be economics, it might just be personal reasons that they want to sell. So always submit a cheeky offer. And a cheeky offer is always the testing and negotiation of boundaries. What the upper boundary will be or the lower boundary will be for a seller selling his property. So it is a good time to buy. It is really a good time to buy, in my opinion. I can't see the market going down any further. I can see the banks freeing up on their lending criteria in 2012. And I can see the inflation has gone up. The CPI went up to 6.2 yesterday. Which and inflation is a very good thing for property, because it pushes the value of property up ultimately, providing affordability is there for people to buy those properties. So I think it's a good time to buy.
Okay, great. I think we don't have a lot of time, Bill, because there's so much information that's come out here. I wish we could actually sit here and make an hour and a half, maybe 2 hour video, but there's a lot of information, and just for the sake of time, we just have to cut a little bit short. We've got about 2 minutes, but I want you to tell us a little bit about you've been in the industry, you run a business for Rawson Properties since 76, am I correct?
Well, I opened my first office in 1982.
Oh, okay, 1982.
Yeah, right. So I traded on my own from 1978 to 82, right, with one or two people, but I then felt I'd made sufficient money, and I wanted to take on the big guns, right, and see how strong they are, what the principles are, and see could I do it and just have fun. I actually never sort of built Rawson Properties to make money.
Okay. Was your passion?
It was my passion. My passion to uplift people, and train and educate people in feeding themselves, right, in the selling process. And I think it's a wonderful profession and a great career in the property industries. It's always changing. You're always learning.
Now, you must be more or less the same size as these big guns, as you say, because you also know one of the big guns. Am I right or wrong?
We're getting there. We're not. We still got brand to catch up on brand. I'm very, very happy to say that after entering the Johannesburg market 5 years ago. We now are almost a household brand there in 5 years.
Right.
And we are certainly doing the same, we're now doing the same turnover in Johannesburg as we did doing in Cape Town. So, put there is no holy cow in property industry, so anyone can come along and providing you're prepared to put your a lot of hard work into it and efforts and think smart, think out of the box. You don't have to follow other people, as I think I've proved. I haven't gone and spent a fortune on advertising and marketing, as I believe that it's 90% of it's wasted. You don't know where it's gone to. But the pure energy and I think our attitude is we're there to serve people. We go out there to serve and help people with what the property problems as such, or opportunities that we want to look for.
Well, thanks very much. And I think, what I've heard here quite a bit is, you're serving for people. And I think that if we look at a lot of, specifically the investor industry, I mean, they need and they thrive on education, new information. I think you've got a lot to offer there. And I would like to see some more in the very specific giving value to investors from your side. So at some stage we'd love to get you involved in that state. And I think there's a book inside there. I can hear because I think it's you need to take that knowledge out there, and we need to put it into something which I think can really add value, because I think there's massive value there.
Yeah.
Well, anything in closing?
I think your first property is the most difficult property to buy, and in my case I borrowed from various people to buy that first property, but do anything to get into the property market. I think it's an experience is obviously the testimony, ultimate testimony. And if you have a bad experience with one property, don't write property investment off. Look over a few, analyze it over a few experiences, not just one.
Great. Well, thank you very much for the opportunity.
Pleasure.
Thank you.